is why you will see, when you look at the annual report of it, the annual report would list, I used 30 billion, but maybe it's 50 billion, is the difference between asset and liabilities. You have it. We could access it. I will share it with you. Now, the Apple shares are trading at a valuation of 700 billion. So 700 is way above the net book value of Apple shares. So part of it is your brand. So how much we said the brand? 300 billion. But there is still another big amount of 250 billion that is not reflected. Are you with me? What is the 250 billion? So brand is one. It's what is Apple going to do in 1 year, in 2 years, in 5 years down the road. This also has a value that is not reflected in your balance sheet of last year, but will be reflected in the value of the company. So this is quite, so in the valuation, the net book value is good, but it's the most conservative way. Think of Apple, think of Google. The net book value is extremely low compared to the actual value that they trade. So this is the most conservative value that you will get. The second type of valuation, and I will show you examples that I went through and how you will see the different ranges of valuation. The second one is we say, okay, we looked at cardiodiagnostics. Let's assume cardiodiagnostics has a $1 million profit. Let's assume that cardiodiagnostic, we've done the net book value. The net book value comes up to about $500,000. So it's the total assets minus total liabilities, $500,000. But we know that they are making $1 million in profit. So the other way we say it's not $500,000. We added to the $500,000. We added the brand because now he has reference sites. He's installed into 3 leading hospitals, big hospitals that are using this. So this has a certain brand. He has used this as references. I'm willing to double. And I'm willing to come up to $1 million or to $2 million in terms of valuation. So this is one way, which is the asset-based valuation. The second way is what we call the market multiples. What is the market multiples? And I'll show you examples of it. The market multiples is I will take all companies similar to cardiodiagnostics that are available in emerging economies, in Asia, in Africa, in South America, in Eastern Europe, and I will say in the Middle East, and I will say these companies that are publicly traded, what do they trade in terms of multiples of their operating profits? So they will tell me, and this data exists. So what I will say is they will look, and I will show you some of the data that I used. They will go through it, and they will say, Constantin, on average, these are 50 companies that are in the same sector in the different countries. These 50 companies trade at 10 times the profits that you have. So this is the actual valuation. So this is what we call market multiples. So then I will look at cardiodiagnostic. If cardiodiagnostic is making $1 million in profits, I will use this average and I will say the value of the company is not $1 million or $2 million, which is the net asset value, but it is actually a multiple of their operating profit. And the average multiple in this sector is 10 times. So it's 10 times 1 million, it's $10 million. So this is a second approach. And this approach is also widely used. And I show you, for instance, I did it with a solar company that is here. I called my friend I called Maria Shatti, actually is a friend of Flora also. And I said, Maria, I need to have data on these solar energy in emerging companies, photovoltaics. So Maria I contacted Youssef Deeb, who is the head of Saradar Bank. I said, Youssef, I need to have the list. And I'll show you what Youssef has provided, what Maria has provided. I had a whole list of all the other companies across the world that are publicly traded in the same sector as the companies that I was trying to value. And I came up with an average, and I'll show you how this looks like. So this is a second way of valuing the company, is I came up with a valuation which is a multiple of the operating profit. Are you with me?
Can we call them also benchmarking?
It is benchmarking. So what you're doing is you're benchmarking your company versus other companies in the same sector. So these companies will do, and these companies will be different types of companies in different, with different financial results, but I will know how I stand. Now I use the average. If, for instance, I'm the owner, and I will say, okay, I'm making $1 million today, but Constantin, so I'm taking the place of Ziad. He said, Constantin, my potential is not $1 million. I know I could be $5 million in 2 years down the road. So I have a much higher growth potential than any of these public companies, and I want to have a premium on this average. So it's not 10 times. I think I could push for 12 times or 15 times because of my growth potential that I have that the others do not have. Because I'm still, so these are then discussions that you have based on how you are positioned versus the other benchmarks that you have done. So if these benchmarks are more conservative and I'm much more aggressive, I could claim for a premium. On the other side, if I'm less in terms of my growth projections versus what the other companies have done, I could get a discount, so I will get at a lower valuation. So this is the second way, is not looking at my balance sheet with assets, liabilities, but I look at other companies in the sector. I looked at their profitability. I look at how much they trade in terms of value compared to their profit. I use this multiple, and this multiple is then used to my profit, and I come up with another valuation. Yes?
But there are markets which are much more dynamic. So if you have nationwide market potential, is much higher than if you sell only in Lebanon.
Absolutely. I think it's a very good point. So what you do is when you get the data, I show you the data, we have it by region. So you'll have Asia, you'll have the Middle East, you'll have Africa, you have South America. We have this data available. So then you could compare which Lebanon is closer to which entity. So this is where you do, and maybe the closest to it is, I don't know, is Southeast Asia and not North Asia. So you're absolutely right, but you will see that there is not a huge difference between one region to the other region. You do. Absolutely. So what you do, and it's a very valid point, and we'll see it in the third methodology, is let's say it's about we agreed 10 times, and most of these countries are stable countries. Lebanon is not stable. We don't know what is happening in terms of the elections. We don't know whether we're going to have a devaluation. We don't know if we might end up having some higher interest rate that comes in, because we had higher interest rate 3 or 4 months ago. All these are elements that are increasing the risk of Lebanon versus the risk of, take a region like South America or a region like. So what you do is you say, but Lebanon is Lebanon. Because of this, there is higher risk. Because there is higher risk, I'm going to take a discount on this value because of the risk that you do. So this discount will be a function of political stability. It could be a function of the financial stability. You know, if the pound could devaluate, Lebanese pound, what will be the impact on my business? I'm sorry? It could be liquidity discount. It could be the fact that your company is a small company where all the other companies are much larger company. So you have a number of elements: political risk. It could be the size of your company versus the one that you have benchmarked. It could be the financial risk. It could be liquidity risk. All these things will add up, and then we'll come up with a discounted value. Okay? So I will show you concrete examples of valuation that we have run and how we take it into consideration. So it's a very important question. Yes?
Are you talking about incorporating the discounts after coming up with the value, or in the first place when we want to calculate our work?
Okay, so what you do, the discounts, normally what you do, the discount is, or the risk premium are reflected into what we call a discount rate. And I will come to discount rate. Now this is, for some of you who are not finance guru, this is the third one, which is called discount cash flow. Okay. So take the example. You will see, and this is a very important example. One of the companies two of the companies that I'm working with, they were in Ghana. So Amer was in Ghana. I met with him there. So one of these companies is producing yogurts. So this is high protein and high nutrients yogurts. So what they did is they bought the piece of land. They built the factory on this land. And then on their balance sheet, the land was reported at the value that they bought it. So this is, let's say $1 million. And they've built the factory. The factory costed $1 million. So we had $2 million on the balance sheet. Now, what happened over the following 5 years is the value of the land increased tremendously. So it moved from 1 million land plus 2 million, it moved to about 10 times the value. So what you do in this case is you adjust your balance sheet to reflect because here it's a huge impact that you have, and you have a much stronger balance sheet because your land value, which was reported historically, does not represent the reality, and this is where you have. So this element, and this happens a number of times with a number of companies in emerging economies where the value of the real estate increase.
You should reconsider your business model because the tax that you should pay on the capital gains.
Yes.
Can your business bear such taxes?
Yes. This is also a very good point because once you reflected, you normally should pay the taxes. But what happened in reality is you will only activate that, so it becomes a liability, but you only pay for it when you sell it. If you don't sell it, you don't have to pay. So what you do is you have a higher value. You would have potential of future taxes to pay in terms of liabilities that will reduce a bit to that. But overall, your asset value, your net asset value will be higher. So this is one way. But if you sell, then you will have to pay the taxes
So your
that are.
cash won't be adjusted or
They won't.
influenced.
It won't.
However, the sheet, your balance sheet will have
Will-
a huge liability on your balance sheet.
You not huge. You will have a liability which is lower than the increase that you had in terms of the real estate value. Okay. So now here is the this process. I'm going to give you the slide set. The slide set. It's okay. We have. So this is you have different steps. Each one of you have different steps. Some of you have seen this slide. This is the one on valuation. So the valuation that we have, different company valuation, using the adjusted net book value, the discount cash flow value, and the market multiple analysis and recent transactions. So these are 4 different values. Okay, this is, let me start with the easiest one. Okay, they haven't, EBITDA. So I just summarized it here. Okay, so in this one here, the net asset we reduce. The EBITDA, this is your profit. So you'll take your multiple. So in this case here, this is what I explained, is equity, then apply a price or multiple to these cash flows. The price depends on a number of factors. Okay, so this is when you look at and you benchmark, you see what is the multiple, and you apply the multiple to your company, and you get to a certain value. You'll get these slide sets. The company has a certain net asset value, so we have assumed what is the net asset value. So the net asset value we have taken from his balance sheet. We've taken total assets. We subtracted from the total assets the total liabilities, and we came up to net asset value. This is net asset value. This net asset value, let's say in this case we've done the exercise, let's say we came up to $5 million in total asset. This is the difference between what you have and what you owe, $5 million. Now we've adjusted this to reflect, fair market value. So the price of the land, fair market value, he bought the land, and the land in his assets was reported at a certain value 10 years ago. Today, it is much higher. So adjusted to fair market value. Here, typically, it's real estate. So this is land, and this is building. I've also adjusted for what we call the brands. So Technica has built a brand. This brand has a certain value. We adjusted for the brand, and we adjusted for intellectual property. So this is because they have certain patents. They today have produced a robot. This robot is this is value that they have. So what we taken the net asset value, which is basically your total assets, lands, building, cash, whatever you have, minus liabilities, whatever you owe. And we came up to a net asset value of $5 million. We've adjusted in terms of reflecting the new value of the assets, the land. We adjusted for the brand value. And we might have come up to about $10 million. This is one way, a net asset. Yes?
Can it be lower?
It could be lower. It's a good point. Yes. So the adjustment, it's a great question, Zaki. So how can it be lower? How can your adjustment be negative instead of positive? Okay, so for instance, the land actually went down. We bought the land at the peak before the Civil War. Civil War came, the value of the land, or look at Dubai. Dubai prices collapsed. So I find myself in a situation where I thought I had a land worth $1 million. The reality is my land is worth $250,000. So here, the correction is negative. So what you do is you have, and most investors will correct it. Okay, so this could be an example. So this is one way, is that the real estate value went down. The other way is the following. Give me ideas where my assets are overestimated. What could it be?
Intellectual property.
What?
Intellectual property.
How can an intellectual property could be negative?
If I'm talking about the patent, maybe
Yes.
it's in the end year of the patent.
Yes.
After 1 year, like everyone can produce.
It doesn't. Okay, it could be. It's possible, but it's not the real.
Superior technology has come. So
Okay, but it makes your IP obsolete. If you had IP on your balance sheet for this, and then suddenly this IP is worth nothing because another technology comes, what you had on your balance sheet is gone. So it doesn't count. So this could be another way. The other way that you have is you could have potential skeleton. What could be potential skeleton? Potential skeleton might be that you have a lawsuit against this. The lawsuit is not reflected in your liability. you end up losing the lawsuit. This could cost you a large amount of money. This is potential liabilities that today are not reflected in your balance sheet. So this is quite important. So Zakiya has a very good point, which is the correction might not be, in most cases it is positive, in some cases it could be. So potential lawsuit is one. Your IP that you have reported is maybe worth 0 and you thought it was worth something. Your real estate value is much worse. So these are examples where the correction could be negative. It could be badwill. So you could have, you screwed up, you had Perrier when they came up with the contaminated water for things. This is a huge impact that you have on the so your brand takes a beating. So the brand value that you had, it still exists, but it's much lower than you had. And you had example with pharmaceutical companies, you have example with others. So these are examples. But in most cases, you typically will have your asset value will be positively impacted. Okay? Then we use the other one, which was the, what we called in here, the multiple. So the market multiple. So what you do is you benchmark, and I will show you an example of the benchmark. And this could be 10, it could be 50 companies. And these companies will have a certain value. And what you do is you look at the value and you divide by their operating profits. We called EBITDA the operating profits. And this gives you a multiple. And this multiple could be 10 times. This multiple could be 20 times. You can use this multiple to multiply with your own profit. Now the third one is your discount cash flow. What is a discount cash flow? It's going to be a bit Chinese for some of you, but it's very easy. I'm going to take the example of Rula. Very simple. She has, again, Rula. So Rula has her dental place. Okay, so has dental. So let's assume that Rula is, so she has, we are here in 2018. We're moving to 2019, 2020, 2021, 2022. So I will look at Rula. I would say, Rula, okay, how much revenue you think you're going to make? So Rula would say, Constantin, I'm going to make, of course, these are all hypothetical numbers. So she will say, this is the revenue. She said, Constantin, in revenue, I'm currently at $1 million. So the million, here we're moving to $1.5 million. Here I'm going to be at $2 million. I probably will end up here at 2.5 million, and then I'll end up at $3 million. This is, okay, this is your revenue. Give me your total expenses that you have. She's giving me her expenses. Constantin, I'm running here at about 0.7 million. Here in this case, I'm about $1 million. In this case, 2 million at about 1.4, 1.3 million, etc. I will go. Then I will do is I will look at her, from this, I will look at her operating profits. And her operating profits, it comes, so this is in the future. Here it's about $0.3 million. The 0.3 will move to $0.5 million. We do this exercise together. It will move to $0.7 million. In this case, we move to, let's say, 1.5. It will move to $1 million. And in this case, it's about 1.8 in expense. So here is 1.2 million. So what I do is to keep it simple. I sit down with Rula. With Rula, we come and we project for the next 5 years. What are we going to do? How are we going to grow? We might expand from Beirut to Tripoli to Saida to Tyre. We might have, so this is my revenue, this is my expenses, and this is my operating profits. I then take these operating profits year after year, and I will then apply what we call a discount rate. So I will say, what is a discount rate? Because the value of $1 in 2022 is not the same value as what it is today, because you have devaluation risk, you have a number. So this discount rate is the rate that you apply in order to discount her profit till here. So how do you define a discount rate? I'm going to be a bit technical. It doesn't matter if you don't understand. I'm using now the case of Nada. Nada has her art gallery. Nada funds herself with two ways. Either she funds herself with money that she puts from her own pockets, or she funds herself from her husband or her uncle or her father funds it. So this is equity. So she has put equity into this company. Now, she and whoever has put equity in her company believe that I'm going to get money back because the value of this is going to increase. So there is a cost for this equity. And the same way when Sami invested, Sami in his mind knew how much he's going to get by investing in Ziad's company? I didn't ask him the question, but if I asked him the question, Sami would have told me, Constantin, I'm expecting a 25% return coming from Ziad. My cost of equity is 25%. Year after year after year. So and most venture capitalists will tell you 25, it could be 30%, it could be 35%. So there is a certain understanding. When I invest, I'm expecting a return back.
So it's a 25% on the investment.
On the investment. So if you took this money and put it in a bank account, it's as if this bank account is giving you not 10%, but giving you 25% every year. So now cost of equity. Now maybe in the case they realize that this is more of a social enterprise, then they will say, no, I don't need 25% because I know that Nada is going to help a lot of disadvantaged people to learn about arts. So she's a social enterprise. I am willing to give it, and I only want a return 15%. So this expectation in terms of return is important. The more you're a financial investor, the higher is this value. If you're a social investor, I'm willing to go with a lower because I know that she would have a social impact that is important, and I'm willing to forgive about the return, and I'm happy with 15%. This is the cost of equity that she has. Now, the second way that she could raise funds is to go to the bank. The bank will say, we like you, 10%. This is who you are. This is what you have assets. We use as collateral, 10%. Suppose that she got 50% in terms of her money. She raised $500,000. 250 came from her parents, herself, and 250K came from banks. Banks charge 10%. The expectation of her parents or herself is we're expecting 15%. It was 50-50, 250, 500. So her cost of capital is 12.5. So what we have done is we have, together, we looked at the cost of debt, we looked at the cost of equity, and I'll tell you, cost of debt is very simple. You go to the bank will tell you this is how much you have to pay. The cost of equity, you go to the shareholders, and the shareholders will tell you. So Sami will tell you a certain figure. I have another friend, Michel, who is managing Al-Fanar. They provide to social enterprise. The rate of return is much lower because they want to encourage this. I'm saying that the early stage companies have a much higher risk, and because of the higher risk, my discount rate will be very high. One is the banks will never touch you because they don't trust unless they're, and the equity will ask for high returns. The more you demonstrate that you can come up with product and you can grow, the lower the discount rate is going to be. If you're a publicly traded company, the discount rate could go down to maybe 10% when you are traded, because this is a mature state. So from 50% to 10% depends how well you grow your business. So this is the notion of discount rate. Now, why is it important? Because the value of any company that is they look at your projections, and then they discount it. So in this case, I'm going to assume it's simple. We have here 12.5. I will take what is the value of Rula's business on this basis. It's going to be, I take this profit in 2018, I put $0.3 million. I will add to it the profit next year of 0.5, but I will divide it by 1.125. This is the 12.5 that we have, because there is a discount rate, so the value of the money is coming down. And I will take the following year, the 0.7, and I will divide it by 1.125 to the power 2. I will take the $1 million and I will divide it by 1.125 to the power 3, etc. So the higher is this figure, the lower is your valuation going to be, okay? So discount cash flow takes your cash over a period of time and discount it back based on the discount rate. And this discount rate is just a reflection of the risk. If you are first year of operation, it's high. If you have proven to me that after 2 years and 3 years you can grow your business, this value is going to go down. What is the lowest? Probably around 10%, but you will never get to 10% when you're in a growth phase. This is only when you are already in the public. From 50% to 10% is the range of these discount rates. Are you with me? The lower is your discount rate, the higher will be your value based on a certain number of projections. Yes?
You usually take 5 years?
Normally 5 years. Normally 5 years. No, normally you take, I mean, I don't want to technical, but you go to what we call cash flow. You actually take what we define as free cash flow, but for the audience here, I don't. But in summary, your operating profit is as close you could get to your free cash flow. But the free cash flow is a bit more, yeah, Raja.
But can I just add that I think you're going to mention is that DCF is rarely used for early stage companies. It's not really the more common method. The multiple method is what will be more often used in
Yes.
startups.
You will have the multiple methods, or you'll have the method that I use with him. Give me the amount of time you have spent. This is what you get. But here, if you ask me for a startup, new ideas, that goes to, let's say, speed that you have. Valuation are typically, we went through the exercise with Ali and his wife. So valuation will be between $500,000 and $1 million. So this is where you are at the idea stage, $500,000 to $1 million.
So you're doing money, but yet, let's say you're doing $10,000 a month.
Yes.
Then you're not zero, you're not making any profits. You have
Yes.
profits, you have profits.
Yes.
But you're not doing a lot of money.
Yes.
A big amount of money.
Yes.
So how do you value at this stage?
Okay.
Where you have profits, but they are not enough.
Okay. So for profit, we know that most companies will never make profit, neither the first year nor the second year, in some cases not even the third year. And you have some companies that are today quoting at multiple billions of dollars that are still not profitable. So this is because what I look at other criteria. I look at how much customers, new customers you're getting. For me, what's important is the traction. If you have more and more customers interested, this for me is important. I understand that today you're not making profit because your costs are higher, but if this goes, because I would look at other companies in the US that start the same thing, and I realize that it took them 5 years to make profit, but afterwards they were able to make it and make it big. So in this case, profit is not, in this case will not be, I would look at the multiple, not of profit, because your profit is 0 or negative. I will look at the multiple of your revenue. So what's important for me is how is your revenue growing? Now the multiple might not be 10 times, it might be 2 times or 3 times or 4 times, would be lower. So I will look at the multiple, but I use the same methodology, I will benchmark. So what you do typically is where is the money used? So in this case, if you have 500,000, where is this money going to be used? And what is going to be the incremental revenue that you generate? I will take these incremental revenue. I will look at the related expenses that there is. Whatever is the operating profit that comes in that I discount at 20%, 25%, whatever is the rate, this gives me the value that of this investment. And in most cases, before we make an investment, in all the boards that we do, one of the big subjects is we need money. To do a factory. Show me. If I give you the money, what is this factory going to produce? So we look at the model, we look at the expenses, we look at the discount cash, and then we find out whether this is worth it or not worth it. Are we creating value or are we destroying value? Okay, so this methods of, and I know for the non-finance people, this is a bit of Chinese. It doesn't matter. So what we have is 3 methods. One is you look at what you have assets minus your liabilities. You come up to a certain value. The second one that you do is you look at your other companies and they trade at a certain multiple. This multiple is then used to reflect your own numbers. And the third valuation is based on your future that you discount back and you get a certain valuation. The reality is that you put all 3 and you match them. And I will show you a slide what I've put for one investment that we have made. And then there is a discussion that takes place because all of them would have a certain range.